If I had to look at AMD today from scratch, knowing what Intel just put on the table, what Meta is doing with Amazon's chips, and what the biggest AI labs are quietly buying behind the scenes, I would not treat this like a normal earnings week. Most people look at a semiconductor stock ripping higher and think, okay, good quarter, nice guidance, everybody clap, move on. But that is not what this is about anymore. This is about the market trying to figure out whether AI is still only a GPU story or whether the next wave is moving into CPUs, custom silicon, cloud capacity, enterprise software, and all the boring plumbing that actually makes the machine run. Today is Saturday, April 25th in New York. Comment what day and date you're watching from, because this market is moving fast and I want to know where you are seeing it from. And if you value my work here, support the channel by subscribing and comment, John AG Best. Simple as that. It helps push the video to the people who actually want serious market breakdowns, not just the loudest headline of the day. So let's walk through this carefully, because Intel did not just report a decent quarter. Intel gave the market a new question. And that question is this: what if the CPU is not dead in the AI era? What if the market got so obsessed with accelerators that it underpriced the rest of the compute stack? Now, Intel's reported numbers were clearly better than feared. Revenue came in around the mid-13 billion range. Adjusted earnings were positive. Adjusted gross margin landed around the low 40s. And the company guided the next quarter to roughly the low to mid-14 billion range, with adjusted earnings still positive. That matters because turnaround stories do not need perfection at first. They need evidence that the bottom is behind them, that demand is improving, and that management can finally surprise in the right direction. And for this report, Intel did that. But the bigger point is not only Intel, the bigger point is AMD. Because if Intel is saying CPU demand is getting stronger because AI is moving from training into inference and agentic workloads, then AMD investors have to pay attention. AMD is not just a GPU company. It has server CPUs. It has data center GPUs. It has client chips. It has networking and software around the stack. So when the market hears that production AI still needs a strong CPU layer, AMD suddenly gets pulled deeper into the conversation. Now, don't misunderstand me. GPUs still matter. A lot. Training big models still requires massive accelerator clusters. That is not going away just because Intel had a good call. But AI in production is not the same thing as AI in training. Production AI means millions of requests. It means search, retrieval, memory, permissions, routing, tool calls, code execution, logging, security, and all the boring things nobody puts on a flashy slide. That is where CPUs matter. Think of it like this. The GPU is the muscle in many AI systems. But the CPU is often the traffic controller, the coordinator, the thing that keeps all the other parts from crashing into each other. And when AI agents start doing real work, not just answering cute little prompts, that coordination layer becomes more important. That is why Intel's commentary hit the market differently. It was not just, hey, we sold some chips. It was, hey, the workload mix may be changing. And if the workload mix is changing, then the companies with strong CPU exposure may have more room than investors thought. That is bullish for AMD, but it is also dangerous because now the bar is higher, and this is where a lot of people get caught. A stock can be right fundamentally and still be risky tactically. AMD can have a great business, great products, and great exposure to AI, and the stock can still sell off if the earnings call does not clear the new expectations. That is the part nobody likes to say during a rally. So what does AMD have to prove? Number one, server CPU demand. Not vague demand, real demand. Management needs to show that enterprise and cloud customers are still buying high-performance CPUs in a serious way. Number two, CPU attach around AI systems. If inference and agentic workloads need more CPUs alongside accelerators, AMD should be able to show it in the language of the call. Number three, pricing and mix. Are customers buying better products, higher-end configurations, and more valuable systems? Or is revenue growth coming at the cost of margins? Number four, supply. Can AMD actually get enough capacity to meet demand? Because demand that cannot be shipped is not revenue. It is just frustration with a ticker symbol. And number five, share. Is AMD gaining ground, or is it just floating because the whole water level is rising? Those are different stories. Now, based on recently published numbers, AMD is scheduled to report its fiscal first quarter after the market closes in early May, and the company describes its portfolio as spanning AI-optimized CPUs, GPUs, networking, and software. That is the exact kind of full-stack language investors now care about. The question is whether the results and guidance can support that story, not just the marketing language. And here's the twist. Intel getting better is not always purely good for AMD. Some Intel positives are industry positives. Strong server CPU demand? Good for AMD. More AI inference needing CPUs? Good for AMD. But Intel Foundry progress? That is Intel specific. Intel getting more competitive in servers? That can become a threat. So you cannot just cheer every Intel headline like it belongs to AMD. You have to separate the read-through from the rivalry. That is what makes this setup so interesting. Intel's good news raises the odds that AMD's environment is strong, but it also raises the standard AMD has to beat. The market is now leaning forward, waiting for confirmation. And when the market leans forward too far, even a small disappointment can knock it off balance. Now let's zoom out because the AI infrastructure story is getting much wider than one earnings report. Meta just made a major move with Amazon Web Services, bringing tens of millions of Graviton CPU cores into its compute portfolio for agentic AI. Meta said its agentic AI work is creating more CPU demand, and Amazon described these workloads as real-time reasoning, code generation, search, and multi-step orchestration. That is not a tiny side note, that is a giant flashing sign saying the AI build-out is becoming more CPU intensive, and that supports the same theme Intel was talking about. Again, this does not mean GPUs stop mattering, it means the architecture gets broader. Training is one layer. Inference is another, agentic workflows are another, cloud routing is another, software integration is another. The winners may not all look the same because the workload is no longer one simple workload. This is why I do not buy the lazy argument that Meta using Amazon chips is automatically bad for AMD. Maybe at the margin, every chip choice is competition. Fine. But if Meta is expanding compute at scale, diversifying architectures, and needing more CPU-heavy infrastructure, that still tells us demand is growing. AMD does not need to win every socket in the world to benefit from a bigger world. The same logic applies to Anthropic. Google parent Alphabet is reportedly committing up to roughly $40 billion to Anthropic, with a smaller chunk now and the rest tied to performance targets. Amazon also expanded its Anthropic relationship, with a commitment that includes billions invested and a massive long-term cloud spending agreement. That tells you the AI labs are not slowing down their search for compute. They are trying to lock it up before someone else does. From recent market updates, this is becoming an infrastructure arms race. Not just models, not just apps, power, chips, cloud contracts, custom silicon, data centers, cooling, networking, and software layers. That is the full battlefield. And then there is ServiceNow, which tells us the other side of the story. ServiceNow reported solid growth, with subscription revenue in the high $3 billion range for the quarter, growing around the low 20s year over year. It also raised its full-year subscription outlook. On the surface, that does not sound like a disaster. It sounds like a very profitable enterprise software company still growing nicely. So why is the market nervous? Because Wall Street is no longer just asking, are you growing? It is asking, will AI change your business model before you can fully monetize it? That is the software fear. If AI agents can automate workflows, summarize tickets, write code, move tasks, and handle service processes, then platforms like ServiceNow may become more valuable. But they may also face pricing pressure, margin pressure, or a different monetization model. Both things can be true at once. And this is where the market gets brutal. If you are a software company with premium expectations, good numbers are not enough. Investors want proof that AI expands your platform, not eats your seat-based economics. They want to know whether agentic AI drives new revenue, higher usage, better retention, and stronger margins, or whether it forces you to spend more just to defend what you already had. That is the uncomfortable question. ServiceNow says it is dealing with some near-term margin headwinds from integration and investment, while expecting leverage to normalize later. The company also reported strong large deal activity and a much larger base of big customers. So the bullish case is still alive. The bearish case is not that the company is broken. The bearish case is that the market wants more certainty before paying up again. And honestly, that is fair. Because AI is changing the way investors judge everything. Chip companies have to prove capacity and demand. Cloud companies have to prove return on huge capital spending. Software companies have to prove they are not being disrupted by the same AI they are selling. Everybody has a test now. And there is one more piece people keep underestimating. The capital spending cycle is becoming a filter. In the last AI cycle, investors rewarded almost any company that could say artificial intelligence with a straight face. This cycle is different. Now the question is, who actually gets paid when the data center gets built, when the servers get filled, when the model gets deployed, and when the enterprise customer finally signs the contract? That is why memory companies, networking names, power equipment, cooling systems, and data center operators keep showing up in these conversations. AI is not a single product. It is a construction project, a utility project, a chip project, a software project, and a customer adoption project all smashed together, and every layer has its own bottleneck. For AMD, that matters because the company is not trying to win by copying Nvidia point for point. It has to win by being useful across the stack. CPUs for the host layer, GPUs for acceleration, software to make customers comfortable, partnerships to get into the right clouds, and enough supply discipline so growth does not come with ugly economics. That is the part I care about most, not just revenue growth. Quality of revenue growth. Because if a company grows by discounting too much, the market will eventually punish it. If it grows by selling scarce, valuable compute into real demand, the market treats that differently. Same top line, totally different story. So when AMD reports, listen for tone. Do they sound like demand is pulling product out of their hands, or do they sound like they are pushing product into the channel? That difference matters. Pull demand is powerful. Push demand can get messy. And remember, the market does not wait politely. It reprices before the full truth is visible. That is why Intel's report moved AMD before AMD even reported. Investors are constantly using one company's results as a clue for another company's future. Sometimes that clue is useful, sometimes it is misleading. That is why we verify the thesis instead of marrying it. The current thesis is simple. AI is broadening. CPUs are relevant again. AMD has a chance to benefit. But now AMD has to prove that chance is becoming actual business. So where does that leave AMD? It leaves AMD in a powerful but delicate position. Intel's results make the CPU story more believable. Meta's AWS deal makes the agentic CPU story more believable. Anthropic's huge compute partnerships make the infrastructure story more believable. And ServiceNow's pressure reminds us that AI winners still have to prove business quality, not just narrative quality. If AMD confirms strong CPU demand, healthy data center momentum, disciplined supply, good pricing, and credible AI GPU progress, then the story can keep moving. But if AMD sounds cautious, if guidance is soft, if management does not give investors enough detail, then the same excitement that lifted the stock can turn into pressure very quickly. That is why I would not treat this like a casual earnings print. This is a checkpoint. If you're successful, share your success story in the comments so others can stay motivated. I mean that because markets can feel lonely when everybody online is pretending they knew the move before it happened. The real skill is not screaming bullish after a stock already ran. The real skill is knowing what evidence you need next. For AMD, I want to hear confidence, but I also want specifics. I want to hear about customer demand. I want to hear about supply. I want to hear about CPUs next to GPUs. I want to hear about margins. I want to hear whether the full stack story is turning into dollars, not just slides. For Intel, I want to see execution continue. One strong quarter helps, but turnarounds are not won in one quarter. They are won by stacking evidence over and over until the market stops laughing and starts underwriting the future. For ServiceNow, I want to see whether AI becomes an accelerant or a margin headache, because the market is watching that software question closely, and it will not stay contained to one stock. So yes, Intel crushed expectations. Yes, AMD investors got a serious read-through. Yes, the AI infrastructure trade is broadening. But do not confuse a strong setup with a risk-free setup. That is how people get humbled. The best investors stay excited and skeptical at the same time. Excited enough to see the opportunity, skeptical enough to demand proof. And proof is what the market wants next. This is for education only, not personal financial advice. I'm sharing how I'm thinking through the setup, but your money, your timing, your risk tolerance, and your decisions are yours. Do the homework before you press the button.